So we just got a report saying that inflation is coming down, but not fast enough. And most people don't understand why this is a big deal. Part of this is pretty obvious. I mean, people are running out of money as savings rates keep falling. The second part to this is that higher inflation means that interest rates will stay higher for longer, and that has a lot of implications for our government and businesses and spending. And now third, this high inflation is slowing down the economy and is also making it more difficult for Americans to go out and find a new job. So what I want to do today is go over number one, what's happening with inflation, but more importantly, I want to go over now how you can build wealth despite what's happening with inflation, because this also creates opportunities. As of today, inflation is at around 3.3%, but the Federal Reserve Bank says that they want to see inflation fall to around 2%. Now that might not seem like that far apart, especially considering that a little while ago, inflation was over 9%, but this is where what the Federal Reserve Bank says is that getting inflation down from where we are today down to the 2% level is going to be the most difficult part, because this is where inflation is getting sticky. The interesting thing about inflation though is if you ask people, is inflation good or bad? Most people will tell you that inflation is bad. But the real answer here is, well, it depends on who you ask, because inflation hurts the people that don't understand it, but it benefits the investors. I mean, if you take a look at the middle class over the last 5 years, the middle class has been getting squeezed by inflation. Yet over the same 5 years, investors have gotten very rich because of that same inflation. This is where your financial education becomes so important, because that can help you decide what to do with your money. That way you can actually benefit when inflation happens. But the problem is a lot of people don't have the financial education. So this is where many people will then turn to a financial advisor, which is a good thing. But then the next bad part is that many people don't know how much they're paying their financial advisor, especially in fees. For example, do you know how much a little 0.85% fee is going to cost you over the course of your investing career? It's not going to cost you $10,000 or $100,000 or $500,000 or even $750,000. It's going to cost you over $1 million, because that fee is also going to compound as you're trying to build your wealth. So homework for you, if you have a financial advisor or if you have a 401k, after this video, go and check what your expense ratio is and see how much you're paying with fees. But I do have some good news for you here, because with our sponsor Facet, you can work with a team of licensed CFP, certified financial planner professionals, who are not going to charge you a percentage on your investments. Instead, they'll charge you an affordable flat membership fee. That means you don't have to pay commissions to their team of planners. You don't have to pay fees based off of how much money you invest, and there's no minimum number of assets that you need to start investing with them. Facet is building the future of financial planning, and they can help you with pretty much every aspect of your financial plan, from career benefits to investing to retirement planning and more, and it's all included in your membership fee. And the best part of all is that our sponsor Facet is waiving their $250 enrollment fee for new annual members. So if you want to learn more and see how you can get started with a Facet membership, I got the link to how you can do that down in the description below. So now that we've established that inflation is a problem, the question is, what is being done today to bring inflation down? And we've talked about now the Federal Reserve Bank, who has done two things to bring inflation down. They've worked to raise interest rates, but they've also done something called quantitative tightening, but they just changed their stance on quantitative tightening. Let me start by explaining what this means. When the government wants to spend $5 trillion that they don't have, they can borrow this money from you and me, but regular people don't have trillions of dollars to lend to the United States government. So then the United States government might call up another country like Japan or China and say, hey, can you lend us some money? But they might also not have $5 trillion, which they haven't had. This is where the United States government will then turn to our central bank, the Federal Reserve Bank, and say, hey, can you lend us $5 trillion? Now this creates a little bit of a predicament, because the Federal Reserve Bank isn't sitting on a cash pile. Instead, they have the ability to print money. And so this is where the Federal Reserve Bank can push a few buttons and create this trillions of dollars out of thin air. Then they can lend this money to the United States government, and then the United States government has to pay this money back plus interest. Now by now we know the impacts of inflation. It makes the value of the dollar go down, causing the price of things to go up. We understand that. But let's go a couple steps backwards now and understand, what does this mean for the Federal Reserve Bank, who had to print these trillions of dollars and lend it to the United States government? Because now on the Federal Reserve Bank's balance sheet, they're holding on to trillions of dollars of treasuries, meaning loans, to the United States government. And so this is where now one of the things that the Federal Reserve Bank has been doing in the past to bring down inflation was selling off some of their balance sheet, meaning selling off some of these treasuries because, again, they bought these treasuries with created money out of thin air. So now to help reduce the inflation problem, to help reduce how many dollars are in our economic system, the Federal Reserve Bank has been selling off their balance sheet. But then on June 1st, 2024, the Federal Reserve Bank changed their stance on this because then they drastically reduced how fast they were reducing their balance sheet, meaning they drastically reduced how many treasuries they were selling off. Now, why would they do that? Now, part of the reason might be because they think that they've essentially won or are winning the fight on inflation. But the second part could also be that they're worried about who's going to buy all these treasuries. Because if the Federal Reserve Bank is selling these loans, somebody has to buy them. And the Federal Reserve Bank is sitting on trillions of dollars of these loans, and there might not be enough buyers out there to keep purchasing them without triggering some bad event in our economy, particularly in the bond market. So what we know now is that the Federal Reserve Bank has been doing two things to cool down inflation. Number one is that they raise interest rates significantly, but then they kind of have just kept them the same for the last year. The second thing is that they worked to increase their quantitative tightening, meaning selling off their balance sheet. But then as of June 1st, 2024, they cooled that process down as well. So now they have these higher interest rates and then the balance sheet, which is lower than where it was before, but they're not selling it off as aggressively as they were before. So what does that mean what becoming in the future? There are two dates that I want you to note down. Number one is July 31st, 2024, and the second is September 18th, 2024. These are the next two dates that the Federal Reserve Bank is going to announce what's going on with inflation and what's going to be coming with interest rates. Now, if you've been keeping up with financial content, you probably know that earlier in 2024, there was a lot of hype and excitement about the Federal Reserve Bank cutting interest rates multiple times in 2024, which hasn't happened yet. And now you kind of have the Federal Reserve Bank saying that, yeah, we might cut interest rates once in 2024. Maybe we won't cut interest rates because, well, they're not sure if the sticky inflation is going to come down to their target of 2%. But even beyond just the direct impacts of inflation, I also want you to take a broader look at what's been happening to America. I mean, if you take a look at what's been happening with the middle class, inflation has been hurting the average person. Now, like I said just a few minutes ago, inflation hurts the people that don't understand it, while it benefits the people that do. And most people don't understand inflation. And so now, when we still see this high inflation today, it's lower than where we were, but it's still high. I mean, low inflation just means that the prices of things are growing less quickly than they were before. It does not mean that the prices of things are falling. The price of things falling would mean we have a negative inflation. So if inflation goes from 9% to 3%, that means the prices of things are still growing, just not as fast as they were before. And this hurts the average person. So on one hand, you have the Federal Reserve Bank saying, we want inflation to fall. But at the same time, inflation is not falling fast enough. And the person who pays the price is, of course, the people that don't understand it, because that means, well, your groceries keep getting more expensive, your rent and your housing keeps getting more expensive, cars and everything gets more expensive, while wages generally have not kept up with inflation. And so this is where what I want you to understand is that there are ways to win when the economy is up and when the economy is down. We know that our economy goes through cycles. We've seen this happen decade after decade after decade. I mean, we saw a forced recession in 2020 when the economy was shut down, but we saw a recession in 2008 with a market crash. We saw a recession in 2000 and 2001 with a market crash, and we're going to continue to see more recessions and pains in the economy in the future. And all of these things create opportunities. But the people that can actually win and find the opportunities are those that are financially educated and those that are prepared, which is why what you want to be doing is building your financial education, building your financial preparedness. That means, number one, not spending all of your money. You got to have some cash, number one, as a buffer to protect you against an emergency, and number two, to be able to capitalize on opportunities. I say this all the time now, but you can see the greatest best investment opportunity in the world. But if you don't have any money to buy it, it doesn't do you any good. That's why you got to start building that financial education through your preparedness, but that's also learning what types of things do you want to be investing in? How do you build your financial education? Start with YouTube. Learn about investing. How do you analyze a stock? How do you analyze a rental property? How do you buy your first investment? Then read books. Go out and spend $20 reading a book on how to do this. Maybe you listen to podcasts. Maybe buy a class if that's what's right for you. But you got to start investing in your own financial education, because the mistake that so many people make is they start preparing when things go wrong. But then it's too late. We know that things will go wrong. This has happened every decade in the United States economy for the last century. it's going to keep happening. And this is where what you want to be doing is preparing when times are okay. That way you can take advantage of opportunities when times are not okay. And it sounds rough and mean, but the reality is that's how money works. Either you understand it and you don't, and unfortunately most people don't understand it. This is why inflation keeps killing the majority of people, because inflation keeps making the value of your dollars go down, making the prices of things go up. Inflation hurts consumption. Inflation means you have to spend more dollars to buy your groceries. Inflation means you have to spend more dollars to live and survive. But for investors, inflation means that your investment values have gone up. It means that your dividends have gone up. It means that your assets have gone up. So it has benefited investors. Now, of course, there's negatives to inflation when it comes to investments as well, because if people can't keep spending money, that's going to hurt business values also. But investors have built a lot of wealth while the average person has become poorer. And this is where you can complain, kick and scream, or you can learn the game. That way you can build wealth in this economic system as well. And it is hard in the beginning. The first few years are the most difficult. But if you stick with it, then you'll have a whole lifetime of financial freedom because you put in the work to spend less, to earn more, to invest your money, to build your financial education. And unfortunately, we're not going to learn these things in school, but if you can spend the time and energy learning how this works, then you can really build your wealth too. But you have to understand how the system works, and you have to understand how to win in this financial system. The typical home is now selling for less than asking price for the first time since before the pandemic. And the reason why it's important for you to understand this now is because of inflation. The Federal Reserve Bank says because inflation is cooling down, they're on target to start cutting interest rates before the end of 2024. Unfortunately, this is not a battle you can win without any pain.